The good news is that the market tends to not have another down year after an already dismal year.
Yeah.
For whatever that is worth.
Well, I think the best news is it won't be 2022 anymore, because we want to just say goodbye to it completely. But I think the beginning of the year is where the highest probability exists for there to be a little bit of a recovery rally. I would be surprised if in the first 2 weeks of January you did not see a return of capital into the equity market, into the fixed income market. Tax loss harvesting, you'll see a return of capital from there. I think generally right now the expectation is that the CPI print on January 12th is going to be a benign one. So I think the setup is a favorable one to get a recovery rally heading into earnings. I'm not going to go beyond what happens.
I mean, Ed Yardeni is out with a new note today. Not necessarily looking for, a huge thing in the stock market to start the year, but a favorable CPI. Inflation may be falling faster than widely expected as part of his note today. The problem, Jenny, is based on our CNBC stock survey results, people aren't looking for much next year. I mean, a third say we're going to have below average returns for next year. You've got 27% of those we asked say 1 to 5%, and 9% who say negative. So that gives you an idea where sentiment is, where positioning probably is. What do you make of that?
Well, when you say the problem is that people aren't looking for much next year, I actually don't see that as a problem. I think it's terrific, because I think one of the most important things that's happening this year is that expectations are being reset to reasonable. And if we have reasonable expectations and behave rationally, we can actually set ourselves up for a decent investment environment for the next 3, 5, 10 years. So we cannot lose sight of the fact that over the past 10 years, prior to 2021, the market returned 16.5%. And everyone's so miserable about this year, like, oh, it's the worst, it's awful, I'm down 20%. Well, you know what? If you're down 20% this year, you were probably up 30% the year before that. You're probably up 18% the year before that. The annualized return on the market over the past 3 years is right where it should be. It's about 7%. Over the past 5 years, it's about 9%. And I think that if we collectively as investors have rational expectations and behave rationally, we will make the returns that will get us to functional places in our retirement. So when the expectations for next year are not much, what is that, 6, 7, 8%? Sure, the market historically returned 8 to 10, but 6, 7, 8% next year after a year like this, to me, that's just fine.
The question is, Jason, do we have the capability of even doing that, given all that we know that, or we think, lies ahead?
Yeah, I think it's an important question to ask, and I think Jenny makes a great point in just what the last 3 years have been. This is the first negative year in the last 4, right? So when I look to turning the calendar, which I know we're all excited to do that for 2023, the first thing that comes to mind is obviously the Fed. We're closer to the end of this tightening cycle. I mean, 400 plus basis points in 1 year. These are historic numbers. We might see another 50 to 75. And as we've been talking about all year, and the Fed has talked about in their commentary, then they'll likely hold. Right. And I think some of the concern as well is what are the lag effects of all that has happened already this year with labor, with owner equivalent rents, housing, all these things will take shape in 2023. But I think once we can get beyond that, there is some opportunity. And I think the market, again, 20+% in the S&P, 30+% in the NASDAQ. History has told us that we don't see a lot of negative years 2 years in a row. So I think those also can play well going into the new year. And let's see, how the next couple quarters and what presents itself here.